Hello, everybody. I'm your boss, Joe Boss, and welcome to another daily plan. We're starting the week strong here. Starting the week strong. We got something interesting here. At least I went ahead and I. But man, good stuff so far. So dollar's rebounding a little bit here. all's well so far when it comes down to any more risk on expectations, to be frank. So is the low end for the week. That's genuinely going to depend on US CPI tomorrow, which is what everybody and their mother is currently saying right now. That's nothing new. That's what everyone's talking about, is how the CPI is going to be. Oh my god, there's so much uncertainty about it. Did you read the outlooks? Nobody knows what the hell is going on. Well, let me say there are some good models around forecasting CPI that are quite accurate. And even if CPI does come in essentially at consensus, or a little bit above consensus, or even a little bit below consensus, what people are losing track of as traders is the change in expectations. So note, inflation on an absolute level is still very high, and that makes living kind of a bit of hell, right? The cost of everything is still super high. But professional traders are not necessarily interested in what the absolute price of something is unless it's relative to a prior or a future point in time, and that number is different. The change in that absolute number, the rate of change, is what we're interested in. And the rate of change of inflation and the rate of change of all these other economic indicators are improving. And don't get me wrong, you can have some mixed data in here and there, but once you smooth it out and you're looking at net, I mean, maybe outside of what is it? CPI just did a reweighting. US CPI just reweighted multifamily and single family homes, and they started to weigh single family homes more because that part of the index actually was a bit more volatile, was getting up there. So they reweighted that to be heavier on the services part of the index. So maybe it comes in a bit higher. Maybe their models, the models that are creating these consensus numbers, aren't properly calibrated, so they overshoot it or they undershoot it. We could be in for a surprise, I think, tomorrow. A lot of people could be quote unquote surprised because they just had some lazy quant in the back end. They didn't update the CPI weights after they announced, oh yeah, we had the change the biggest part of our weighting system. We forgot to change the weights in it. Oh, we were so surprised our model was caught off guard. You had a 2-week, 3-week head start, bucko. Oh man, that's gonna be hilarious. Anyways, let's start hopping down the gamut here. As far as last week's expectations, so these arrows are time stamped from last Friday, where we did a week ahead expectation. And so far on New Zealand dollar, so good. Euro dollar is essentially, all the dollar pairs are essentially in the same basket, except I think for CAD and pound. Those are in slightly different camps. Pound actually might outperform, if I may say. The outlook around the Great British Pound over like the next 2 months is significantly improving. Quite a lot. I mean, last week, you can use these indicators in replay mode, by the way. You can see we identified this tail risk last week. And, when you start hitting these far out spots here, like on a lot of these assets, that's very strong momentum, and that can indicate a regime change. It can say, hey, the rate of change of your economic data is starting to improve more meaningfully. You're getting back on track. And more and more of the smart people that I follow, who I've been following for a few years, that I really enjoy their commentary for, are now talking about a no landing scenario where there's no recession or only a minor slowdown. Again, I don't truly believe that, because for most people, for the median person, not the weird average person that's kind of skewed based off all the people who make loads and loads of money. I'm talking about the median income and the median person. They're feeling the squeeze, and they're going to continue feeling that damn squeeze probably up until like the second quarter next year. It's not going to be fun for the median house. It's just not. Economically, it doesn't matter what economic thing Biden tries to do at this point. He's so wildly unpopular. It'd be amazing if he gets anything through, at least on the US side, to try and improve things on that front. You do have to pay attention to geopolitics when you're trading, by the way. Just because I mentioned Biden does not mean I'm, putting my bias on him, while I am looking at polls, and why you have to pay attention to changes in regimes, because changes in regimes come with different economic regimes. The Democrats and the Republicans don't always have the same economic views, So you have to, I don't know, guess what? I have a thread on the Discord talking already about economic ramifications of if Trump or if Biden win the election. There's already outlooks. There's like a 3-part outlook that Wells Fargo posted going over all the analysis already here in March. And they were doing some of it back in February. For those types of things, which, you could consider these economic regimes in the US to be 4-year cyclical, right? It's actually worth your time if you're managing hundreds or billions of dollars in portfolios to be aware of presidential cycles and how presidential cycles might influence your portfolio. So thinking a year ahead is kind of what you need to do if you're going to be playing a more cyclical 2, 3, 4 years cycle in that portfolio. You got to be thinking about how that impacts it when you're responsible for that much money. Maybe not necessarily when you're trading your, $1,000. Too many people are going to be going around and saying, I'm not too interested, and then I want to check out my PP coin, my Pepe, my Doge, right? And then everyone's just here forgetting about Litecoin, right? LTC, USD. The Litecoin's up, I think, 20% today. Yeah, there it is, the big 2-0. Bitcoin's up 4.4. ETH is up 3.9. Guys, so many people just sleep on Litecoin. It's like, people talk about Ethereum, people talk about Bitcoin. It's like, some people are like, oh, Litecoin's the silver to gold. I wouldn't even make that comparison because I don't even view them as even like remotely comparable. I was seeing some commentary actually talking about, the move here in gold is so similar to the move here in Bitcoin. I don't know about you guys, but if I go ahead and I overlay this real quick, if I go and do GC here on the same scale, I don't know, does that look like the same thing to you? Here, let's try and do this. Let's put this on a new scale over on the right. Yeah, around here it started to look similar. But what wasn't going up here for the last 2 weeks? Anything that was denominated US dollar was getting banged on. because the dollar just a 1.4%. It fell 1.4%, and all these equities were rallying because they were outperforming. Okay, so there's some correlation between all these assets. There's some correlation right now. That's it. Just because there's correlation right now doesn't mean it's safe to go around making, general blanket statements of like, oh, because in the last week Bitcoin and gold moved together, it must mean they're influencing each other. Yeah, let's see how long you can hold on to that assumption for until it starts making you lose some money. Just whenever Bitcoin goes up, you buy some gold and do that every day until your bank account hits zero. Because it might work for a few days. It might work for as long as these things are correlated. But Bitcoin is not correlated to all these other assets. It has a unique structure. Same thing with gold. The same thing, frankly, with some yields of some countries. That's why you kind of want a global diversification of bonds. Not just, oh, I'm going to, trade bonds and the yields and the equity indices. No, you have to put a bit more effort in there if you want true diversification there in your bonds and your equities, your equity indices. Throwing different commodities in there during different parts of the year, especially stuff like hogs and lumber, right? Uranium. That seems to be starting to get some hots again, right? I mean, it's up 50% in the last year. How many of you guys knew this was going on here? Oh man, yeah, and then since 2022, this thing's been doing real well. It's recovered a lot of this move here. And guess what? Nuclear is slowly becoming more and more popular over time. This is just something to look at over the next several years, to watch. All right, let's get into these assets here. I mean, I don't have a terrible amount to say other than the title of the stream, which is, if you look at all these weekly charts and you're a bull and you're not scared about the bit of uncertainty we have going into the CPI, this isn't the end of the world on taking long shots. And if the CPI does come out poorly, well, guess what? It's probably not going to surprise poorly to like 0.6%. If it did print, if CPI printed at 0.6% month over month, there's gonna be some hell in these dollar markets. Dollar's just gonna totally reverse this entire move here. Bitcoin might still stay high, gold might still stay relatively high, but all these currency pairs, all the kibosh is just gonna come down swinging on them. This dollar yen is gonna, I don't even think this dollar yen would actually retrace all that much, to be frank. The yen is already in a tightening position. A US CPI surprising to the upside would just have it match the rate of inflation growth we're expecting out of Japan. So this might actually go flat. It might be a bit volatile. It might pull up like 100 or 200 pips, but it's I don't think it's going to reverse all this thing on a US CPI surprise to the upside, because the yen is still on the stronger side of things. Let's check out dollar CAD here. So yeah, there we go. Dollars are dollary ducato. I'm checking out this 8 hour here. Thank you, Big. I'm just checking it out, what it looks like. Yeah, that's a likely high. You go ahead and check out here. Yeah, that's a likely high for the week. And this is dollar CAD, so the pair is kind of flipped. Down on this is favorable for the Canadian dollar, and up is favorable for the US dollar. And it looks like we did a good set of expectations for the week ahead. It was down, up, down. At this point, we said it could go up. And then on this bar right here, we actually updated our closing expectation from going up to going down and closing down here. And considering the volatility, that's probably within a margin of error of that expectation. And then I didn't really set expectations for here on the dollar CAD, on the euro dollar. I didn't set expectations because, quite frankly, I was expecting a stronger pullback over the last 24 hours on a lot of these US dollar pairs. And it just makes me think that, well, I mean, yeah, this is essentially what I was expecting. Here's Aussie dollar. Pulls back here. Again, this was done last Friday during the live stream for the week ahead streams, March 8th. Pull back down here, rip, roar, and tear, and then maybe pull back into the close. And most of the US dollar pairs, this is essentially what I'm expecting. Because I have no reason other than a reweighting really in the CPI to expect any sort of major CPI surprise. So long CPI comes in nominally or even comes in lower, dollar should be getting weaker and all these rallies should be continuing. So it's like, I don't know, out of those three scenarios, if I weighted them equally, 33% for a higher CPI, which would be dollar good and risk off, 33% for neutral CPI, which would, or consensus CPI, which actually would be, risk on, dollar bearish, and then 33% for an underperforming CPI is super risk on and super dollar bearish. So in 2 out of 3 of the, if just we equally weight all 3 of them, 2 out of 3 of the 3 possible scenarios are bullish. And we frankly can kind of argue that even if the number for CPI is even just moderately above the consensus, like it's 10 or 20 basis points above the consensus month over month, that it will only have a short-term risk off event, and people will buy that dip because the net long-term change in expectations for the next quarter is for more significant improvement to be made on unemployment, wage price, the wages paid, and inflation, headline inflation for all the developed countries around the world. And there's really no reason to not expect those things. It's really just, are we on pace? Is the recovery occurring? Again, traders aren't focusing on the absolute level of things. They're looking at the relative value from this print compared to the last print and the expectations of this print compared to the next print. So long the future expectations are continued to be expected to improve, and our data at least stays flat and we're not having these big shoots and spikes to the upside, it's mostly going to be a buy the dip sort of couple of months here. I mean, I try and listen to all these guys who are super bearish, and it doesn't make any sense. It's, you know what it reminds me of? A lot of the conversation of all the guys who are bearish now. It's like I'm getting deja vu. It's like all this stuff from back over here, all over again. Oh my God, we're so overdone. I was even bearish over here, and I drank the Kool-Aid over here, guys. I drank the Kool-Aid over here on the towards Q4. Like, oh my God, we're gonna start going into recession in Q1 of 24. Oh my God, this is gonna be so bad. But sometime in December, I snapped out of it. Around here, I'm like, oh, the bears are just projecting their uncertainty on economic data that hasn't printed yet. And we have no reason not to expect it to print well. It's not like they're providing us with any models or any forecasts or any super solid rationale on the mechanisms on why CPI or why some economic event would actually have a negative impact on the future expected path for the change in economic data, for the change in overall expectations. I mean, this is now kind of turning into a rant stream, but it's just, you know, sometimes people get stuck in trying to figure out trading so much. They try to figure this stuff out. And then when I walk in, I say, you just have to figure out what current expectations are, what future expectations are, and then the difference between the two, so you understand how expectations now are expected to change in the future. And once you have that down, you just have to learn more about what it is you're actually trading, so then you can set better expectations, and you can go and look at the expectations of the bulls and the expectations of the bears and be a better expert in judging which one's more likely to be right, who has the better arguments. Do those arguments make sense? Do you know enough to make sense of those arguments? And that can take a long time to learn. So it's not like the path isn't there on how to get good. It's just not an easy walk. And as you go through it, there's a lot of ways to get confused. Like here, right? Oh my God, we're going into recession. Duck, cover, grenade. No, no, we've now doubled this move pretty much since then. And now the forecasts for like 5,400 almost seem trivial next month if you look at these monthly ranges. I mean, if we go even a bit higher and close up here, this peak for next month's highs is going to be right around like the high 130s, 130, the 5,300 handle, low 5,400 handle. It's just going to be nuts, you guys. It's just going to be nuts. This momentum is going to be crazy if it actually comes through. See, just can't let the bears try and get their FOMO onto you of, oh, I'm so uncertain about what's going to happen. I don't know what's going to happen. I think I just need to get short here. I think I just need to get short here because it can't go any higher. We're so overextended. Guy doesn't understand momentum. Guy doesn't understand positive expectations. The guy doesn't understand just excitement and exuberance in markets. Oh, what's that great quote? Markets can stay quote unquote irrational longer than you can stay solvent. That's just how it goes. That's just how it goes. You go through one or two of those experiences and you're like, okay, I've learned my lesson. Let's see here. Oh, wow, that's probably a likely low. I've seen some targets for oil in the like $85 handle, but that's probably going to be I think maybe like the low $80 handle, maybe towards the end of the month seems more likely to me. Let's pull this up. Yeah. It's the seasonal expected value ain't great here on oil. But once you get past this 11th trading day, it's kind of smooth sailing for the rest of the month. I mean, outside of this 20th trading day in March, you got nice positive seasonal expected value there. Let's go ahead and check out that. Oh, look at that. A lot of our lows for the week here on oil are hanging out right around there. I am actually kind of curious on that Aussie dollar here. What are our weekly low odds? Wow. Not the best for continuation. This is kind of scary here seasonally. Again, there's an assumption here with these seasonal indicators is that the data is behaving seasonally. And I can't in good conscience say that this data is behaving seasonally. This is very, I think price can kind of be on the scale of mean reverting and trending. There's a lot of systems that are like that. They kind of are on this continuous scale from like trending to mean reverting. And momentum is a form of trend. And seasonality can really fit in either or. Seasonality isn't just a mean reversion thing. Like, oh, it goes up and it goes down during specific times of year and cyclical. It can be trending when you zoom into the seasonal data. Bit technical of an explanation. But essentially what I'm saying is that the seasonal interpretation here was something like the probability pivots might not be our best tool for this week ahead. So I got some uncertainty. The probability pivot points. But the ranges, I think the ranges will do just fine here. Though I'll save my patootie here. Bitcoin, it's still chugging. I wonder if I can get this thing to load quarterly data. Yeah. You're getting to the edge of the distribution here for the quarter. God, look how scrunched that low distribution is. And ain't loading right. Yeah, man. The further and further out you get on this distribution in Bitcoin, the more and more sketchy for exponential pop moves that are thousands of dollars become. Like, that is sketchy. This is a nice, more predictable trend. But when you start to go parabolic is when you start to get those exponential multi-$1,000 pops in this sort of positive trend environment. And right now we have the positive trend, but no pops, which means we're not really parabolic yet, which means there's probably a risk there of going parabolic potentially this month, quite likely if CPI comes in below consensus for whatever reason. It'll just send Bitcoin up another 5-10%. We'll be in the mid to high 70K range by end of week. And gold is also not out of the picture, by the way. Gold is now, I think, like I said in the... Oh, I have to go to GC here because I got my drawings there. We are now in the box. We are in the box. And our forecast in the box is for up and then just for nominal drift lower. And that's it. But I think this actually might be incorrect. Again, depends on how that CPI plays out and how the rest of the world's CPI also plays out. But while this is my nominal expectation based off the indicator, I might have to end up just like in last week, update the expectations towards the end of the week to be more bullish here on gold as well. You know, Bitcoin has the supply thing. They have the disinflationary money supply thing. Gold has other properties that are good for the portfolio that you don't need to get out of Bitcoin here. So it's nice to see that it still has the positive upside. Nice to see that actually the commodities are doing pretty well, and I consider Bitcoin as one of those commodities. Let's see. Well, we already commented on a lot of assets so far. Actually, it's kind of hard to see how these yens are going to move. We have B of J, Bank of Japan, coming in next week, and they're expected to hike, get out of NERP or ZERP. Which is, well, NERP, NIRP is negative interest rate policy. ZERP is zero interest rate policy. They're going to go from NERP, negative interest rate, to ZERP, zero interest rate. That's the expected move next Tuesday, I believe, for the Japanese assets. And that's just going to send the yen higher. The yen's going to strengthen probably another like 100 or 200 pips off that move. It'll be a record move on the yen once that happens. And then they'll update their forward guidance and probably say, from the expectations that I've read, that the Bank of Japan is going to cut next week, and then they're probably going to cut sometime in Q3. So they're going to have 2 cuts. That's the current expectation, 2 cuts from the BOJ. Either the second cut's expected around later Q3 or early Q4. So sometime around the middle of the second half. We can also check out the ES here real quick. Oh, wow. That looks like a likely low. That is actually, yeah, that's the second greatest probability bin. We didn't hit our expected price. I was actually expecting this to be a lot more conservative, but no, we got our down first, and now it's about, do we got our up first? Do we got our up next? Yeah, check that out. It's working on an 8 hour. That is our greatest probability man, outside of this more conservative spot up here, that is looking sure looking bullish in my opinion when I check that out. Dr. Rage, yeah, I'm not too sure about selling highs on the risk on assets in Q2 because I have the expectation that it's going to be quite momentum-y and have quite decent positive drift. So I'd actually would just do the opposite. My expectation is that. And so my approach is going to be trying to catch some dips when I can using this, right? Stuff like that. And the example I have here on Eurodollar is just an example of that. I went ahead and I took this shot earlier today when we were at this spot. And that's exactly what I'm supposed to be doing based off how I'm supposed to use this indicator. So I just try and do this every week. Let's check out NQ. NQ's kind of it's in the same spot. Yeah, it's in the same spot as the ES, although without the huge wick that the ES had, right? That's a huge wick there, NQ. It's essentially the same move now that I look at it. Yeah, now it's a matter of, are we getting a new high on the equity indices? And like I said last Friday, going past these spots here means you're starting to catch clouds. And I put 2 lines on both of these. I'm like, hey, the exuberance from last week is now being felt and talked about by a lot of people. And if things keep going up post CPI, it can get really crazy because everyone's going to feel the FOMO. All the retail guys who don't look at this, shit every day like we do, they're going to get the FOMO. They're going to come in on Wednesday with their retirement funds. They're going to come in on Thursday with their pension funds. And then they're going to come in on Friday with their child's college funds. And that's when you know we're in trouble because everyone has too much money at that point in. And it's, at that point, you've really pushed price really far, really fast. And at that point, it's just a matter of volatility giving you a bitch slap. That's the real way of putting it. At that point, it's just your price action is so autocorrelated and so volatile. And one side of your order, the bid side of your order book is just so damn thin that on the first sell, it's just, an instant like 5% move lower in a 2-minute bar or something nutty like that. And then it goes in the reverse order, right? You say bye-bye to the college fund, and then bye-bye to the pension fund, and then bye-bye to the retirement fund. And that's why you try and be smarter about these things. Chasing is how dogs get run over. Chasing is how dogs get run over. And they're good dogs, and you don't want that to happen to them. But you can't control the dog, and the dog wants to chase. And all you can do is hope the dog survives, has a near miss, isn't hurt too bad, and can live to see another day. So they learn when they have the urge to chase that car, they don't chase it. The analogies they are on point today. Oh man, I didn't get to go over too many charts because I mean I feel like I didn't cover too many charts. I think I actually covered all the charts I wanted to cover today. It's just the the commentary was just so mind melting. I'm like, I had to get it away from me. So many people are so concerned and so uncertain. Last week I said, I'm feeling pretty uncertain about what's going to happen in CPI. But now going into CPI, just so many people are uncertain about it that it's making them bearish. And I'm like, okay, this is people projecting crap now onto an event that hasn't even been realized yet. And there's going to be some schmuck who shorts into this because of that stupid commentary. Yeah. But then again, I'm not saying that your personal account, should long this either. I'm saying you have to have more certainty when you're making decisions. I have my degree of certainty that I'm expressing here on the stream. I can't see your guys' faces. I can't tell your moods or whatever, or even if you're telling the truth when you're chatting to me. So even if I wanted to tell you something, I really don't think I could tell you anything meaningful for yourselves personally. I can give you my interpretation and what I see, and hope you can learn with monkey see, monkey do, right? On a guy who looks at this stuff pretty much every single day and draws these expectations and reads outlooks and follows expert commentary and tries his darndest to stay on top of expectations. So then when shit like this happens with everyone getting bearish over nothing, we haven't printed CPI yet. There's no reason to be bearish until it's actually printed. I get it, maybe if you have a good model and that model is forecasting a higher CPI, which isn't good. But I don't see the model. I don't see the forecast. I just see people getting FOMO and doing bearish projections because, it feels the momentum. We must be reversing sometime now. We must be. I can feel it in my nutsack. I can feel it. The sentiment, it's turning. The retail positioning, I can see it. Oh, when I close my eyes, the fuzzy little white dots that blink around, I can see the patterns. I don't know. I'm just goofing off now on the stream because I'm fairly optimistic about the future. And I, at this point, now have enough experience where I find it hilarious when I see people go through these experiences and struggle about these things. I'm like, seriously, you've been trading for 10 years and you haven't learned this about how to set trading expectations yet? Like, just wait until the event is out and then have your opinion, right? That's gonna be the point. Don't try and force yourself to have a bias. If there's good reason to have a bias, if there's good data or evidence, but you got a model, like we have our model here with these indicators and our probabilities, then, do your best to interpret that model in the situation, in the context that you have. Understand the caveats and assumptions that you're using, so then you're not misinterpreting the model, and then do your best to kind of like carry that baby home. And maybe that money is that baby is a bag of money. carry that money home. Yeah, hopefully this is a more chillax stream, and hopefully this rubs off on some of you guys who are maybe stressing out about CPI and whether or not it prints higher or lower or as expected. Things are going to be fine. We will live to trade another day. Even if I have these trades here on Eurodollar that ended up losing, guess what? I know how to do my risk management. I got this trade on still from back here that's in the green. And I'm going to have a lot more time to do more trades. And I'm not going all in on every trade. So I know I will be around and have the ability to play around with these trades. So it's just common sense at this point, right? Just have some common sense once you've, I don't know, got all the FOMO and the uncertainty out. It's like, well, there's nothing to worry about yet. CPI hasn't printed yet. Oh, and just wait until you start being concerned next week about, oh, the dot plots, whatever will the dot plots be? It's hilarious. I legitimately think it doesn't matter if they say 2 or 3 or whatever. The rate of change of expectations going forward is net positive, and there hasn't been any sort of significant change in the realized data to pull back those expectations to a scenario where we're going to have some sort of soft or hard economic landing. It's just not the case with the data we currently have. And until that data comes in, I'm going to stay bullish. With that all said, I'll see you guys on CPI when I start to eat all my words. Put my foot in my mouth there, but who knows? Who knows? I'll see you guys in a bit, all right? Take care.